Hello, I'm Nathan Kubik, and thank you for joining us for the 2022 end of the second quarter Transform Wealth Capital Markets Review. I hope everyone has been able to enjoy the summer, and I hope that you're all doing well. A lot has happened during this past quarter, and we have a lot to talk about. Today, we will be discussing the recent volatility, what's driving that volatility, as well as the key influencing factors moving forward. After a discussion on potential impacts from those factors, we'll expand upon how we're positioned from an investment standpoint in a number of our strategies. So let's get started. Inflation has continued its stubborn rise. The Fed did raise rates another 0.75% this quarter and expects to do so again this month. While there are some signs of core inflation slowing, the timing of getting inflation under control remains an unknown. Corporate earnings have remained resilient, and this will be a key quarter to watch those earnings releases, as we should see some indications on the impacts of higher interest rates and the inflationary pressures. Market valuation metrics have moved below their 25-year average, which also has some implications we will be discussing. Ultimately, there are meaningful headwinds facing the markets right now, and how the Fed, consumers, and companies navigate those headwinds will determine what happens next. The big question is, can we accomplish everyone's goal of slowing inflation while not being driven into a recession? As you will see, in each of our strategies, we are positioned with this question in mind. Inflation is the most critical factor facing the markets today. The July numbers just came out, and we witnessed headline inflation rising further to 9.1%. This is concerning. But it is also important to consider core inflation numbers. Core inflation takes headline inflation and strips out food and energy. Gasoline alone increased by 11.2% this last month. Looking specifically at that core inflation number, we see inflation growth of 5.9% for July, compared to the March reading of 6.5%. So this is one important indicator that inflation could be peaking. We also need to understand that this data is already outdated. For example, gas has already come down about 7% from its recent high and is in line with where it was at the end of May. While inflation is the critical issue at play, what we need to remember is that we don't need prices to return to their previous levels. What is needed is for the growth of inflation to move back towards normative levels. And the first step in that process is for the growth rate to peak. Remember that some of this inflation is transitory in nature. Supply chain is one example. Post-COVID supply chain issues have magnified the impact of inflation, but we are starting to see some indications that this issue is beginning to be resolved in some industries. As we discussed, energy is a driving factor of inflation. Here, we consider oil and natural gas prices. An interesting takeaway from this chart is just how low prices dropped during the COVID shutdown and how much it has climbed since the reopening. It is important to understand that much of what we are experiencing today comes to us from the aftermath of COVID. In addition to the government-driven capital infusion, the well-oiled, efficient economic machine from the pre-COVID days was not able to simply pick back up where it was left off. And these inefficiencies have been a root cause to the struggles we are seeing today. That said, we do believe we will get back to the point, and that this recent turmoil is already starting to expedite that process. The consumer does remain strong. However, we are beginning to see signs of rising personal debt and savings drawdowns. Here we consider median home price data. Unfortunately, there is a lag between home sales and when that data is available. As of the end of May, these home prices appear to have continued to climb. But remember that this data is based on the closing, not the agreement to price. Considering that mortgage rates have climbed to 5.5%, there are clearly some negative implications. One thing I want to note, if you look at the chart on the top, is that prior to the meaningful run-up in home values, we did experience 3 years of very little home value appreciation. And if you drew a regression line continuing the trajectory from pre-2017 to where we are today, you would see that we are close to in line with a longer-term growth rate. Additionally, in the chart on the bottom left, we see that we are still below the 40-year average of mortgage rates. So while there are currently headwinds, it's important to consider where we are from a historical perspective. Here we consider whether or not we are currently in a recession. We did have a negative first quarter of GDP growth, and the technical definition of a recession is 2 consecutive quarters of negative GDP growth. Remember that the last recession we experienced was during COVID. While it is possible that we are currently in a recession, the consensus of analysts do not believe this is the case. One important factor in the first quarter number resulted in a surge of imports of consumer goods as retailers struggled with their inventory management in the aftermath of COVID. It is possible that this problem continues, but it is expected to rectify itself over the next couple of quarters. That said, we are cognizant of the possibility of a current recession and do remain positioned with this in mind. The U.S. job market remains incredibly strong. Most recently, U.S. payrolls increased by 372,000 in June, much higher than the expected 250,000. Companies continue to hire. Amid this volatility, it's another good indicator that corporations feel well positioned in this environment. I will also note that wage growth indicators imply that it too might be peaking, which could be construed as a positive from an inflationary standpoint. Job openings remain high, layoffs remain low, and employees are continue to make job changes. These are all positive indicators. On the other hand, consumer sentiment is incredibly low. Looking back at the last 50 years, sentiment is at its lowest levels. This metric takes into account the consumer's opinion on the current health of the economy. Shockingly, sentiment is lower now than it was during the financial crisis, when the markets were concerned with the entire financial system collapsing. While we don't know if sentiment will decline further, it is important to consider the subsequent 12-month returns of each of the last sentiment troughs. If you look at the percentage returns located under each of the dates on this chart, you will see the corresponding next 12 months return of the S&P 500. Now, we're not implying that we've hit the bottom in the markets or that the markets are going to take off from here. However, this chart should encourage investors to understand the long-term opportunity that times like these have historically presented. In this chart, we wanted to show you calendar returns compared to the largest intra-year drop. As you can see, there are many larger declines in years that ended up being positive. Again, that's not a forecast, but it is important to understand that volatility is part of the equity markets. And just one more chart to further illustrate that point. Here we consider historical 2-quarter market declines of more than 20%. These are depicted in red. Looking at the next quarter's performance in blue, we can see an average of 8.5% return for that subsequent quarter. Looking at the next 6 months from the bottom, we see an average of 21.5% return as depicted in gray. And for the entire next year, we see an average of 31.4% return. The point of these slides is not to say we've hit the bottom or that it's time to put the risk back on. Instead, it simply shows what has happened in similar historical declines. From a global perspective, the U.S. performed quite similarly to the rest of the world. Inflation is a global issue, and each country will address it differently. We continue to prefer domestic exposure over the rest of the world, but inflation, along with currency changes, does create additional factors for us to consider when looking at global exposures. With decline in stock market prices, we have seen a corresponding decrease in valuation metrics as depicted by the green line here. Additionally, we have seen a compression in the dispersion of valuations in the market. In this case, many of the higher valuation multiple stocks have been hit harder. Additionally, this has been a market decline where finding areas to hide has been excessively difficult. In our opinion, this does create greater opportunities for some individual companies. As inflation gets under control and sentiment increases, those companies who continue to execute have the potential of being rewarded at a greater degree. Here we consider the 25-year average forward price to earnings ratio of 16.85. As you can see, we have dipped below that average. The forward PE ratio considers two factors. One, the price of the stock market. In this case, we're looking at the S&P 500. And the second is the profitability of the earnings of the S&P 500. We know prices have come down, but what about earnings levels? Well, they've remained resilient to date, and now we're just entering earnings season. This will be an incredibly important period to see how companies have actually performed amid these inflationary pressures. From a forecasting standpoint, as seen in the chart on the left, the consensus of analysts does believe that earnings will continue to grow. It is possible to have an economic slowdown and to also see corporations still continue to grow their earnings. Look at the year-to-date in the chart on the right. Here we consider the actual level of earnings growth year-to-date. Looking at the gray line, we see that to quarter end, earnings have grown about 6.7%, whereas the S&P 500 was down just over 20%. So the earnings for the S&P have indeed grown during this down period. The big question is whether or not the consensus of analysts are correct, and whether or not this earnings growth is sustainable. This is why this particular season of earnings is particularly important. From a style perspective, we have seen value companies move into favor year-to-date over that of growth. Typically, in a sentiment-driven downturn, this is what happens. This sentiment may prove warranted, and the markets have priced in the potential risk of a recession. To that end, we have seen a flight to safety and to companies with lower valuations and more inelastic demand for their products and services. Having been concerned with the likelihood of continued volatility, we have continued to be positioned with a tilt towards value, as depicted in the chart on the right. Additionally, within the growth bucket, we have focused on fundamentals, companies with characteristics that imply more stability. Additionally, we have been focused on stocks with GARP characteristics. GARP is an acronym that stands for Growth at a Reasonable Price. This focus could be considered the more value-oriented subset of the growth style box, and we feel those are well-positioned companies for the future. Lastly, we have approximately 8.5% of the core equity model in a buffer cap strategy. It's a defensive hedge strategy in this portfolio that we use with the intention of dampening volatility. We are also maintaining around a 6% position to a large cap value ETF with the purpose of shifting us further towards the value side of the style box. Both of these strategies are being utilized with the intention of lowering volatility and will eventually be used as a source of cash for future deployment when we determine it appropriate to add some risk back to the portfolio. From a sector standpoint, our largest overweights are in financials and healthcare. Our current underweights are in industrials, communication services, utilities, and real estate. Right now, energy is its own animal and has given back a decent amount of its first quarter outperformance. On a relative basis, more value-oriented sectors like consumer staples and utilities have continued to perform. That said, companies and sectors across the markets are down this quarter. We believe we are currently well positioned from a sector standpoint, but do expect to start making adjustments as indicators begin clarifying where the economy goes from here. Here, we consider our current weights within the core equity model. This quarter, we did increase our healthcare exposure while decreasing our exposure to consumer discretionaries and materials. both of which help this model. One interesting piece to note is the relationship between technology and communication services. Before the S&P 500 separated the technology sector into other sectors, including communication services, these two sectors were just considered technology. They remain highly correlated in performance, and if you look at them in combination, by design, we are actually currently underweight. We are continuing to tweak our exposures as we continue to fine-tune this model based on changing market conditions and are well positioned to shift more meaningfully as more indicators emerge. With the flight to safety, the dividend model remained especially well positioned for this past quarter. This strategy has an inherent tilt towards large cap value and the more value-oriented sectors, which has boded well for this model. It is worth noting that the underlying holdings of the core model have shifted more towards these type of holdings. Holdings that we believe have stronger fundamentals and whose valuation metrics also remain relatively attractive to the market as a whole. While this model will not tilt towards growth like the core model, we are still looking for growth characteristics within the value space. Additionally, like the core equity model, we also continue to hold a defensive portion within this model to the buffer cap strategy as well. We are also aware of the implications of inflation and potentially rising interest rates on dividend-paying companies and are thoughtfully positioning with this in mind. Shifting to the fixed income side of things, we have continued to witness yields moving further upwards. As you are all aware, we have been positioned defensively from an interest rate risk perspective and have discussed the need for patience for the last year or so. Previously, there was minimal upside in yield for extending our portfolio duration, and there was too much corresponding interest rate risk associated with such a move. Now that this risk return profile has shifted and that our clients have been rewarded with less downside exposure, we have shifted some of our portfolio durations to reposition for this new interest rate environment. We are not being overly aggressive here as rates can move higher, but it does appear as though the currently scheduled interest rate hikes are already priced into the yield curve. In this chart, we consider that increase in interest rates by looking at the 2, 5, and 10-year Treasury bonds as proxies. As you can see, interest rates have risen meaningfully over the past year, and especially during this year to date. Remember that the current price of bonds is really just a time value money equation, discounting back future coupon and principal payments using market yields as the discount rate. This has two implications that are particularly relevant at this moment. First, the longer the life of the bond or duration, the more impact a change in yield has on the current price of the bond. Secondly, the more those yields rise, the more meaningful the decline in current price. Let's look at what that means for the last couple of quarters. On the bottom of this slide, you can see the durations of different bond indexes. You will notice that the longer the duration, the more meaningful the decline in price has been. The blue bars represent the total return for the first 2 quarters of these indexes. Now, all bonds were hit, but some at a lesser degree than others. While no one wants to see the current price of any security go down, it is important to realize that for our clients, this is actually a good thing in the long run. This is due to our previous positioning of less interest rate risk and shorter duration holdings. I know calling a decline in market value a good thing is a big statement, but let me explain. By having mitigated a good amount of the downside by being positioned with shorter durations, we now have the ability to reposition and extend that duration by locking in new bonds with meaningfully higher yields for a longer period of years. This higher yield has the potential to offset the current decline and provide additional yield for a net win over the long run. We understand this might be a difficult concept to grasp, but we wanted to share this as we view this as a great opportunity. This opportunity is even more apparent within the municipal part of the fixed income markets. Here we attempt to compare municipal bonds to treasury bonds from an equal footing tax standpoint. Remember that municipal bonds are federally tax exempt and state exempt if within the same state you reside, and that treasury bonds are taxable at both levels. So here we are showing a tax equivalent yield for municipal bonds for illustrative purposes. The graph on the left shows us where we were at the beginning of this year. For the first 7 years of maturities, treasuries actually had a higher yield than that of municipals tax equivalent. Historically, these lines are generally pretty close to one another, but look at where we are today. The chart on the right shows us a meaningfully higher municipal tax equivalent yield curve. This is a great opportunity and one that represents a dislocation from their historical relationship. At some point, we do expect this relationship to normalize. However, we are actively taking advantage of this opportunity. Hopefully, this further illustrates the point that while the bond markets are currently down, in the long run, this shift, along with our positioning, has the ability to create a net benefit for our bond strategies. Lastly, we wanted to show you where the Fed funds rate is today and where it is forecast to go. Remember that we believe much of these expectations are already baked into the longer part of the yield curve. Looking at the blue diamonds, we see that the Federal Open Market Committee, or FOMC, believes that inflation will be brought under control in the next year, and that the Fed funds rate will need to rise past the current scheduled rate hikes. On the other hand, the markets, as depicted in green, or green diamonds, shows us that it believes additional hikes past 3.4% will not occur, and that it is likely due to the belief that inflation will be brought under control sooner. So in conclusion, given all available indicators and economic data, we continue to feel well positioned in each of our strategies. While it is likely we will continue to witness some volatility as we move forward, we feel strongly about the companies we currently own and the way we are positioned going into the remainder of the year. We remain focused on potential risk exposures and are prepared to reposition should indicators shift further one way or another. Know that we are watching the markets and your holdings incredibly closely. We are continuing to position your portfolios in efforts to reduce our perceived downside risk exposures with the intention of maximizing your risk-adjusted returns. As always, thank you for placing your trust in us, and please reach out to us if we can provide you with any additional information or clarity on the information presented today. Take care, and we look forward to speaking with you soon.